From the morning reading, broad markets drift lower as Apple, Facebook, Amazon, Priceline, and Google are weak. Best Buy and others are lower on earnings per share. MU soars. Breadth weakened compared to the prior session as decliners led 1738 to 1247 on the New York Stock Exchange and led 1823 to 955 on the NASDAQ. Volume remained light on Thursday, heading into the three-day Christmas weekend. Indeed, there'll be no trading to speak of on Monday in most markets. Low volume trade on the spiders, diamonds, and tilt are three examples. The broad markets pulled back slightly on Thursday. In that S&P 500 snapshot, the Trump rally continues to stall. Rally is the largest rally net in a post-election period in S&P history, but at some point, all good rallies do indeed exhaust. And the S&P 500 posted another modest decline as it digested an avalanche of economic data on Thursday. The third estimate of the Q3 GDP was revised upward, but the November durable goods orders were disappointing. November personal income was a yawner, and the weekly unemployment claims came in higher than expected. The 500 hit its negative 0.09 intraday high in the opening seconds and sold off to its late morning 0.40 negative intraday low. After an afternoon zigzag, the session ended at negative 0.19% loss. The fourth loss in 7 sessions since the record close on December the 13th. Groupthink is strong on the street. Strategists on Wall Street expect the S&P 500 to rally modestly next year, and by strategists we mean pretty much all of them. There is the smallest difference ever between the most and least bullish strategists. Setting a price target is not the value that strategists add for clients, and we shouldn't read anything into them either, other than perhaps a warning that everyone is looking for the same thing in 2017. It's not just traditional Wall Street. Managers of real money are also showing a strong consensus. The average active investor manager is fully invested and confident about it. That usually means the stocks have reached at least a short-term point of exhaustion. Stocks have gone nowhere for 2 weeks after a decent gain in the past year and a furious one over the past 2 months. The S&P 500 has formed one of the tightest two-week ranges ever. That's considered to be a bullish consolidation pattern after a big rally that has not been a consistent pattern, including the last time in August. Country funds continue to get hit. This time it's China. The optimism index on FXI has dropped below 5 for the first time since January. In the fund's history, its most consistent performance going forward was 4 days later when it rallied 43 out of 60 times, averaging 3.1%. But when it failed, it tended to fail big. The average loss was a large 3.9%. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:17 a.m. Mountain Time, and I'm recording this in preparation for the market day of December the 23rd, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. A couple just kind of operational notes for the next 2 weeks. We have holiday shortened weeks the next 2 weeks, and most particularly this next week, as we're between Christmas and New Year's. Volume is normally very, very light. We certainly have seen that in evidence in the last 3 sessions. Even last night, volume very much off of what you would have in a normal overnight session in the futures markets. We will be doing these YouTube videos on a kind of periodic basis between now and the new year. Certainly if I see any significant action or a change in hedge risk level or something like that, I'll put out a new video. But if we have just kind of a super quiet, go nowhere, super small range kind of trading, I certainly normally shut down altogether between Christmas and New Year's. It's really, really poor time to be an active trader. Certainly if you're an investor, you just kind of ride through it. But if you're an active trader, day trading during low volume periods such as the Christmas week is usually fraught with really poor trading, really poor follow through on your signals due to the low volume. It's a really good time, frankly, to step back, do some research, analyze your trade logs for the year, see what worked, what was your profit factor, what was your expectancy. If you don't know those terms, you need to look them up and figure them out. And then frankly, to reset yourself for the coming year. That's probably the most productive thing that most active traders can do with the Christmas to New Year's period. So bottom line, there'll be some YouTube market preview videos as needed during this slow period, but I may indeed kind of skip some days. I will be actively continuing to support the membership with our daily reports and so forth, but I will be cutting back on these videos and the time it takes to produce them. That being said, one of the ways that you can encourage me to take that time and produce these free market preview videos is to retweet this or to like it or to give me the thumbs up on YouTube. All those activities encourage me to continue to do this free activity. If you find that this is helpful to your trading, it's greatly appreciated to get that pat in the back, as it were, through those various methods. So let's go ahead and jump into the morning report. As of the time of this cut, all four of the U.S. broad-based indices were down just below scratch. Crude oil was down more significantly, though, down over 1%. The euro, long bond, and gold were all just up above scratch. In overseas action, of course, they don't necessarily celebrate Christmas in places like China. They still had quite a bit of activity, down about 1%. Hong Kong down over 0.25%. Japan down just below scratch. Germany down a little over 0.25%. And then the United Kingdom up just above scratch. In terms of macroeconomic reports for today in the United States, of note, you have new home sales and the University of Michigan consumer sentiment. Monday, primary markets will be closed as a trade holiday, so the next active trading day will be Tuesday. So you'll have a shortened week next week. In terms of current volatility conditions, the short-term VIX continues to be exceptionally low. It's challenging the 9 and going below 9.34 is your current reading. Skew is just barely elevated and over the first cautionary threshold at 128. IV percentiles are, for the most part, less than 10. The S&P at a 9, the Russell at a 14, the Dow at a 10, the NASDAQ at an 8. We did have a standard deviation size move put in yesterday on the Russell, -1 standard deviation. The others were less than that on a close-to-close basis. Let's go ahead and take a look at the charts. And mostly this is going to be a story that's going to repeat across every one of these charts of a sideways consolidation pattern after a rather historic move up. Especially if you include the futures activity, this is a huge range with just basically one small short bull flag consolidation, and now heading into a better part of 2 weeks sideways consolidation. But that is nothing when you consider the size of this move. This is really net. This is the largest post-election move in terms of how far it went and how much it gave back at this point of time in the S&P history. So pretty remarkable, and certainly that we would get at some point some exhaustion retracement kind of activity is not unexpected, nor would even a test back into the 2200 area, which might seem big, but given the size of the move, that would still be within the context of a very bullish pattern and wouldn't really hurt technically the pattern at all. Let's see. So on the S&P, you continue with this sideways consolidation and no activity to really push it one way or the another out of that activity. The Dow, the same thing. It's been very much in a sideways pattern in recent sessions. NASDAQ, of course, finally broke through its area of resistance, but has been chattering just above that area, now turns support in a very sideways pattern. And then the Russell, perhaps a little more volatility, as is often the case, but it's still in a sideways pattern. It's just that its range is probably just a bit wider on a relative basis, but still very much draw a box around this. Look for significant confirmed breakouts above the highs or below the lows. The expectation, of course, of all these patterns is for the next leg to be up. In other markets, crude oil did have a bit more of a move last night, was a bit negative, more of a complex sideways consolidation pattern here. Obviously, crude oil continues to trade on a very global market and be more active than perhaps some of these U.S. equity markets. And gold continues to be very strongly bearish, though we've been in something of a sideways consolidation pattern as the rest of the U.S. markets have gone cold. And the dollar, which is a big part of what happens with gold, also in a sideways consolidation pattern, though it did set a new 14-year high some 4 sessions ago. And bonds also sideways consolidation pattern. And then finally, the volatility, which has gotten down to 52-week lows. Not a bit surprising that it would be a new 52-week low during this trading period. From a seasonality standpoint, we still expect a slight bullish bias into the first or second session of January, unless some new information comes into the market to drive, energy and momentum on the low trading volume that normally is present. So I've really beat that into the ground, and you should be listening to that, especially if you're an active trader. Very difficult to be successful in moving the needle on your portfolio as an active trader during this time frame. So be very, very careful. Tighten up those targets and be quick to take profits when you're in low volume environments. Okay, that's probably enough on the charts. Let's go ahead and go over to the daily report. Not much change over here. Still, of course, very bullish overall. Intermediate term phase opinion, market phase 4, price patterns near resistance or extension patterns. The 3 market timing signals are still quite bullish. The first one, of course, all 3 of these are mechanical in nature. The first one comes to us from IBD, confirmed uptrend, bullish. GMI index did drop 1 notch to a 5 out of 6, but still given a buy signal, and that's been in place since 11:10, so that's bullish. Stock charts, decision point scoreboard, all 3 time frames are certainly giving us the consensus to a bullish side. Short term, universally bullish. Intermediate term, 7 out of 8 signals are bullish. Long term are mixed, and this will be only healed if we get a series of higher highs and higher lows. Position sizing opinions, both models coming in at 100%. Intermediate term market posture is exceptionally strong. Bulls across all 4 of the indices, and you note they're all above 90, so very, very high. And this is all supported by an exceptionally strong bullish sentiment line, so any retracements would be expected from a probability standpoint to be relatively mild and short in duration compared to the length and duration of the bullish legs. In terms of hedge warning status, 0+, normal with some elevated conditions. In terms of strategy opinions, no changes here from yesterday. The one area of concern is for those option income strategies. The VIX is below the acceptable range to initiate new positions for novice traders. Anytime we drop below a 12, we take that as something of a caution that premiums available versus the amount of risk being taken on are starting to get kind of skewed to the poor side, and novice traders especially should probably take note of that. From specific areas of warning, mostly this is coming from the volatility zone, and these are representative of the very low volatility that we currently have in place and looking for an expansion of volatility. Now, in normal time frames, we wouldn't expect that expansion to take place until after the new year, but certainly anytime you're this low, the probabilities are for an expansion as opposed to continued deterioration and getting any lower. Distribution day count continues to be high, and the NASDAQ is at a 7. Actually, the skew is above 125, so that is in the first level of warning. And relatively, all these warnings here, warnings are warnings, and we take note of any warning, but within the context of where volatility is at super low levels, these are minor warnings at this point until they start to build. Trend base, everything's bullish here, nothing particularly of interest. The key intermarket risk aversion indicators have all flagged as risk off. One of the things to keep in mind, though, that when you get small range bearish candles, like we've had several sessions of in recent days, that really isn't to be taken as terribly bearish. It's a very, very weak bear activity in the context of the huge, very strong bull overall context. So while these have all flagged as risk off, and we'll watch and see if we start to see acceleration and the rate of change start to pick up across the different warning indicators. I wouldn't make too much of this at this point in the context of the larger picture. From a sentiment standpoint, you see short term, very benign, and intermediate term, a bit more elevated. Overall fear and greed index is down below that extreme greed area now, coming in at a 71. In terms of sector specific, we did have best performance put in mostly by the defensive areas, telecom, that's your Verizon and AT&T. Those are dividend paying kind of big cap, much like a Dow type of performance. So that's basically, when you say telecom, you're basically talking about those two companies. They're certainly part of the defensive area, as is utilities and real estate. Real estate put in a slightly negative performance, but you see overall breadth, less than a majority were negative on the day. So that's where most of the activity came in yesterday. But even those that were negative yesterday were usually mildly negative, with the exception of consumer discretionary was down by some 1%. In terms of market posture across the three time frames by sector specific, the most notable areas are to take note of where this weakness is in healthcare, retail, materials, consumer discretionary, and transportation are the sectors that are showing more weakness than, say, financials, industrials, energy, consumer staples, and telecom. In terms of overall performance, you see we've had some negativity here in recent sessions on quite a number of these, but you look at the 1 week change, none of these even amount to a negative 1%. So pretty mild withdrawal or pullback in these areas thus far, especially in the context of where they have been in the last month. Okay, that is probably enough for today. We're going to go ahead and wrap this thing up. One thing I will comment about, though, is on the YouTube, if you find what I'm doing here is helpful, be sure to hit those buttons, hit those like buttons that you see on the YouTube channel and so forth. But also there's other tools available. If you're not familiar with these, make sure you're using them. When you get a notice as a subscriber, it's a free subscription to the YouTube channel. But if you get that notice, give it just a moment to finish loading up and being able to be available in high definition. Make sure this little gear button shows in HD. If it doesn't, click that and set it to high def playback. You'll have sharper resolution on your charts. Also, you can go to full screen. And then the other thing that you can do with those tools is change the playback speed. And generally, you can probably understand what I'm saying at about 1.5 times what I am speaking at. So that can help save some time. Cut a 20-minute video down to about 13 minutes. Obviously, if you need something that you need greater comprehension on, you can always slow it down or pause or repeat it as is necessary. But very important, frankly, to give me that virtual pat on the back, hit those likes, retweet those messages and so forth. It helps to tell me that you're finding this of value. And then disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll see you back when we see you, as we'll be kind of periodic during the slow trading of the next couple of weeks. Certainly we will continue to broadcast on any session that has done something of significance. In the meantime, manage that risk profile. That'll give you the consistency that you're looking for, and good trading and happy holidays.